Okay, so in this episode, we're going to talk about asset sales. So in the context, the large context of not just M&A, but takeover transactions in general, we have 5 basic categories of transactions. We have mergers. We have asset sales. We have stock sales. We have proxy contests. And we have tender offers. Oftentimes, these will be subdivided into statutory versus non-statutory transactions. And the reason, or the distinction, is associated with the role of the board. So as we know, inside of a corporation, you have stockholders. Up top, these are the owners. Obviously, the critical constituency of a corporation. But from a governance perspective and a control perspective, they have very limited voting rights, limited approval rights, a limited role from that perspective. Below the stockholders, you have the board of directors. And of course, this is the cohort of primary importance from the perspective of governance and control. They are charged with managing the corporation. They oversee strategy. In their capacity as directors, they elect and appoint and supervise the officers who run the day-to-day. But within the context of these takeover sorts of issues, specifically M&A, transactions must run through the board. So if a corporation is selling itself by means of a merger transaction, or a corporation is selling itself loosely by means of an asset sale, those transactions by law require the approval of the board of directors. If we're talking about a Delaware target, a Delaware corporation, we're talking about the Delaware General Corporation Law. And in that case, with a merger, you're talking about Section 251. And in the case of an asset sale, you're talking about Section 271. And in both those cases, the selling board must approve the transaction. The selling board must approve the transaction. These are statutory transactions. These other sorts of takeover mechanics, transactions, activities are considered non-statutory because they do not require board approval. Proxy contest first, this is the notion that you are taking over the corporation by means of taking over the board of directors. So you're not buying the shares of stock or acquiring the assets. Instead, you're the party on the outside and you're knocking out that party. You're the Republicans trying to knock out the Democrats, or you're the Democrats trying to knock out the Republicans. And by virtue of having that kind of change, by virtue of a proxy contest, which is a structured way to take over the board, you take over the company because you now control the most important cohort from the perspective of governance and control. So it's a form of takeover transaction, a proxy contest. Stock sales and tender offers are very much related to one another. A tender offer goes to a very specific and a highly structured and regular type of stock, or regulated type of stock sale. But in both those cases, what you're talking about is a transaction with a buyer here and the existing stockholders here. And this buyer doesn't want to deal with the board by virtue of a merger or an asset sale. This buyer is going directly to these stockholders. So it's considered to be a non-statutory form of transaction. What we are going to focus on in this episode are asset sales. Because asset sales in many respects are the most basic and the most elemental of the takeover transactions. And why is that? It's because an asset sale is just a step removed from what the company does anyway. What do I mean by that? Well, let's express this company structure a little bit differently, illustrate it a little bit differently. So we have our company, and within the company, we have assets and we have liabilities. Assets are the good things, basically everything except people, that go to the value of the company. It's money, it's accounts receivable, it's intellectual property, it's inventory. Liabilities, it's the bad stuff. It's what the company owes. Debts, obligations, commitments. It's what it pays, what it owes the landlord. It's what it owes the bank, attorneys, accountants, what have you. These live inside of the company. On a day-to-day basis, the officers and the employees of the company, under the ultimate supervision of the board of directors, are entering into liabilities and transacting in those liabilities. They're borrowing money, they're paying back loans, paying off bills. They're transacting in assets. They are taking products, inventory, and selling that inventory, getting money in exchange. So this is what a company does, okay? Every day it's involved and active in its liabilities, and it's involved and active in its assets. But in this context, in a takeover context, we have that day-to-day activity on steroids. We're saying we're not just selling one widget, we're selling all the widgets, along with everything we've got. We are selling, and the phraseology is all or substantially all of the assets. And if that's the case, if the company is selling all or substantially all of the assets, we find ourselves living within a specific provision of the Delaware General Corporation Law, Section 271. And Section 271 says, in that case, if you were selling all or substantially all of the assets of the company, this is a special case. This is an extraordinary case. This isn't just day-to-day. You are essentially selling the business. You are extracting everything of value from this company, and you're selling it. As a consequence, we're going to up the ante a little bit. The approval of the board of directors is required, and the approval of the stockholders is required. The board of directors may not surprise us. You're selling all or substantially all the assets. It's a major transaction. Not a surprise they would rise to the level of the board of directors, just under basic corporate principles. But a stockholder vote, we know is extraordinary. And if we are saying by law, hardwired in, that the stockholders need to approve this, what we are saying is that we are admitting or acknowledging that this does represent a sale of the company. And it's such a fundamental transformation. It's such an organic and deeply material transaction that the stockholders, as the owners, as the ultimate constituency, need to be heard. And we need to make sure that they approve this transaction. All or substantially all of the assets. Now, as we know, substantially all, let me add that word, can sometimes be up for debate. And you might think, why would it be up for debate? Why would we care? Well, the statute says if you're selling all or substantially all the assets, you need board and stockholder approval. Well, you're probably not ever selling all of the assets. When you do these transactions, and we'll talk about this more in a moment, you'll find that the buyer is probably going to leave a couple of things behind. and or the seller is going to want to hold on to a couple of things. Could be for a variety of reasons. It could be some accounts receivable that they just want to handle on their own and not transfer over, etc. So it's very rare that you'd be dealing with a transaction that's structured as an asset sale where literally all assets are being sold. 999 times out of 1,000 or more, it's substantially all the assets that are being sold. Well, what is substantially all? Well, it's a little bit loose. Why does it matter? If it's not all, and if it's not substantially all, well, then Section 271 doesn't apply. And if Section 271 doesn't apply, then we don't need to get the vote of the stockholders. We may still need to get the vote of the board of directors because it may still be a pretty substantial transaction, and probably is if we're even having the debate as to whether or not it's substantially all the assets. But we don't need a stockholder vote. And that's where you do see some litigation around what the definition of substantially all is. And it's important and relevant because if the board of directors are trying to execute a transaction and they don't want to go to the stockholders, maybe because they just don't want to spend the time and energy on that, maybe it's because they're not sure they're going to get the vote, but they think that it's in the best interest of the corporation to do it anyway. That's where this can come into dispute. And there are various different principles that apply. Oftentimes the basic rule is you know it when you see it, but courts have to find ways of describing that. So you can look at the total value. Is it more than 50% of all the assets? Does it represent more than 50% of all the revenue, the book value, what have you? Lots of different ways to slice or dice it. Sometimes it gets litigated, but I will say that you could practice in this space for 50 years and you could do M&A work for 50 years unbroken every single day, and I wouldn't be surprised if you never ran into that issue. It just doesn't show up that much. But important to understand why it's relevant and why it's important and where it might come into play. Okay, now note that it says assets. It doesn't speak to liabilities. It doesn't as a general concept, and it doesn't under Section 271. Why is that relevant? Well, this goes to the heart of why an asset sale, or flipped around, an asset purchase, is a very attractive transactional structure for buyers. So go back to what I said a few minutes ago. This is a sale of all or substantially all of the assets of the company. And I mentioned that frequently there are excluded assets. And in an asset sale structure, by definition, they can exclude assets, right? Because it doesn't say it has to be all the assets. It says substantially all the assets. It's still an asset sale. And buyers in particular will take advantage of that. Like I said, sometimes sellers might hold some stuff back, but buyers, by and large, for the most part, are the ones driving this demarcation. Which assets are we buying and which assets are we leaving behind? It's important and relevant because what they're leaving behind, they arguably don't have to pay for, right? So when they're thinking about the purchase price and they're thinking about what they want to acquire, they're thinking about the practicalities. I only want the assets that I'm going to need to operate this business, and there may be a few that are inconvenient or unnecessary, so I'll leave them behind. Or maybe I'll leave something behind that it'd be nice to have, but it's not a have to have, and it's really valuable. If I leave it behind, I don't have to pay for it. Purchase price drops. So it gives them the ability to really fiddle around with not only the practical components of what they're acquiring, but what they're paying for it. The same is true in spades with liabilities. So when you're engaged in a transaction that's structured as an asset sale, the purchase agreement will very clearly and specifically say, these are the acquired assets. This is what the buyer is buying. These are the excluded assets. These are the assets being left behind. Furthermore, these are the acquired or the liabilities, usually the language used, that are being assumed. These are the assumed liabilities. Flip side, these are the excluded liabilities. This is typically a much longer and a much more precise list. In most transactions, you're going to find that the buyer truly does want to acquire virtually all the assets, just leaving behind some things perhaps on the edges that are just more convenient to have the seller dispose of. But with liabilities, there may be items there that they don't want at all. Now, what might they want? Well, frequently there are liabilities that are attached to certain assets, or maybe better put, liabilities that are truly associated with the operation of the company. You see that a lot with things like license agreements, okay? It's a liability, money is owed on that agreement, but it supports the operation of the business, and the buyer's gonna want that. There could be capital leases like that, equipment leases that they're gonna wanna hold on to, because those are tied, they're fundamental to the operation of the business. But maybe there's a big bank loan. Like, why should we assume that $10 million facility, that $50 million facility, that $100 million facility or loan? We don't want to assume that. We're going to exclude it. We're going to leave it behind. Why should we have to pay that off? You pay it off, buyer, or you pay it off, seller. What you owe the lawyer for the transaction, yeah, we're not assuming that. That stays behind. So this list gets hotly negotiated. And you can see that that's of enormous benefit to the buyer, because now the buyer, again, can really, with great finesse, determine what it's taking and what it's leaving behind. Hugely advantageous. And this, indeed, is one of the primary benefits and attributes of an asset sale, and why buyers like them, because they get to pick and choose the assets, and more importantly, pick and choose the liabilities. It's special. It allows for a high degree of variability and intentionality, and it's a very attractive component of this form of transaction. What else might the buyer like? Well, there's a tax component to these transactions that's attractive to the buyer. Now, over the course of discussing these deal structures, it's important to note that tax issues appear with high regularity. And any good M&A lawyer is attached at the hip to a good tax lawyer. And this episode is not about tax. It's about transactional law. And we're focusing on transactional law. We're not focusing on tax. Different course, very complex, and deserves its own 3 to 4 credit hour course on its own. That being said, as an M&A lawyer, it's important for all of us to have some basic fluency in the core tax elements of what's happening in these transactions. And then at a very high level, a tax benefit that attaches to the asset sale form is something called a step up in basis. What's that mean? Well, the buyer is acquiring assets. These assets probably have been fully or largely depreciated in the hands of seller. Well, what does that mean? At a very high level, this isn't a tax course, but at a very high level, what that means is the Internal Revenue Service recognizes that certain assets deteriorate in value, lose value over time. And as a consequence, companies should have the ability to depreciate those assets over time. What's the benefit of depreciation? They can use that on their taxes, okay? It's a way of offsetting gains and income from other sources. It's a tax benefit to depreciate your assets in that way. When the assets are fully depreciated, that privilege, that benefit is gone. And a lot of times, companies are sold, or assets are sold, because a certain maturity in the business has been realized. So it wouldn't be surprising to start to work through the books and records and see that the assets have been largely depreciated. What happens in an asset sale, generally speaking, is that the buyer gets a step up in basis. In other words, they get to take the purchase price, and they get to allocate it against the assets in a coherent, intentional, practical, realistic way. But in doing so, they get to take these assets from being depreciated to zero and give them a new basis, a step up in basis. So now in the hands of buyer, they can be depreciated. It's a tax benefit the buyer will enjoy year after year after year. And by offsetting gains in income from other places, it means they're paying less tax. If they're paying less tax associated with this step up in basis, that's an economic value that's directly attributable to this transaction. It plays into purchase price, okay? They may be willing to pay a little bit less for the business if they're able to get that step up in basis, because they can make up that gap, that difference later through tax savings over time. So the step up in basis is a very attractive tax right or tax privilege that the buyer gets to enjoy within the context of an asset sale. Buyers like that. They like the ability to pick and choose, and they like the step up in basis. Okay, what about sellers? Do sellers look at these sorts of transactions with the same sort of enthusiasm? No. Why? It cuts differently for the sellers. First and foremost, from a practical perspective, we are selling probably substantially or virtually all the assets, but probably not all the assets. So 99% of the assets leave the company, end up in the hands of buyer. 1% of the assets are left behind. What about the liabilities? Maybe 50% of the liabilities are assumed by buyer. What's that mean? Well, 50% are left behind. So what do we see? We see cleanup. This is a very practical downside to asset sales for sellers. It's not a one-step transaction where they negotiate the sale of the business with the buyer, they consummate the sale of all or substantially all the assets and pushing over a chunk of the liabilities, and then they get to count their receipts and call it a day. They have to do something with what's left. Well, what do they have to do? Well, they have to figure out a way to get rid of this asset that's remaining, and they have to figure out a way to handle those liabilities that are still outstanding if truly this does represent the end point for this business. Now, how do they do that? So the transaction is taking place between the buyer and the selling company. So the selling company has these assets to deal with and these liabilities to deal with, but they also have consideration, right, from the transaction itself. Cash, equity, securities, what have you. So now what happens? Well, now we need to come to terms with what happens next. If we're truly selling the business, and if this is truly the end marker, as it is in virtually all these cases, we're looking at our stockholders, and we're saying the stockholders want to cash out. They've sold the business. They want consideration, money, equity, securities, what have you, for what they just gave up. They don't want to continue to be the stockholders of a company. It's got a couple of assets in it, some liabilities in it, and then a bunch of consideration that it got from buyer. It's just stasis. There's nothing happening. It's just sort of, there's no operating business there. So ultimately what we want to do is we want to crack open this company, and we want to push these benefits out of the company into the hands of the stockholders. So we can do this a variety of ways. Well, how do we clean this up? Well, we have to get rid of these assets. Well, maybe we can distribute the assets to the stockholders. Or maybe we find somebody else to buy those assets and we've converted them into cash, which is much easier to distribute, or some combination thereof. What about the liabilities? Well, bad news is we have liabilities to take care of. Good news is we've got cash or other consideration by means to do it. So we could, in theory, maybe distribute these liabilities out to the stockholders, but that's rarely going to happen. Instead, what you would find is that the selling company would use the benefits of that transaction to pay off and discharge these liabilities. So once the dust is totally settled within the eggshell, and we've resolved and liquidated and liquefied to the extent we can these various benefits, now we're going to crack open that egg and we're going to distribute what's left to the stockholders. The net proceeds in the form of cash and or in the form of whatever other consideration was received from buyer will find its way into the hands of seller. Well, seller stockholders. Two things. This is a headache. So that's a downside for seller. Seller wanted to sell its business. And the selling stockholders in particular are now getting excited about it. They get to vote on the transaction, right? Section 271. They're enthusiastic. It's the end of the line. It's what they had hoped for. Hopefully it's a transaction where they're going to make some money. This should be an exciting celebratory event. And in their mind, they're thinking, great, I'm selling the business and I'm getting cash. Well, there's a step in between. And it's the cleanup stage. And this can be sometimes quite burdensome, and it can take some time to do. That's a downside. And by the way, it's going to cost money. I mean, you have to pay somebody and somebodies to handle and manage this and take care of this process. So that's one downside for the seller. Call it administrative headache. Call it logistics. But this is a disadvantage of the asset sale approach. The other disadvantage is tax. So remember how we said that the buyer gets a real tax benefit from an asset sale or asset purchase structure because they get the step up in basis? So from a tax perspective, generally speaking, buyers like asset sales. They like that step up in basis. Sellers don't. Why? Well, if our entity is a Delaware C Corp, or frankly a C Corp anywhere, but we are primarily working with Delaware C corporations, then what's going to be suffered here is double taxation. The corporation, the company itself, must pay tax on this gain. The gain it received from the basic asset sale transaction with buyer. That's one of the liabilities. And then once that tax is paid, and the other issues here are resolved, and whatever's left is distributed or dividended out to the stockholders, there's a tax here as well. The company pays tax, and the stockholders pay tax. The proceeds are taxed twice. An enormous disadvantage to asset sales for sellers, specifically C corporation sellers. Now, if this entity is an S corporation, or if this entity is a limited liability company, taxed as an S corporation or taxed as a partnership, then there might be an opportunity to circumvent it. In all other things being equal, generally speaking, when you have a pass-through entity like that, there's no entity level tax paid. So there wouldn't be a tax liability here at the level of the selling company. Whatever is left on a net-net basis gets distributed out in these liquidating distributions to the owners, and then they would pay tax on gain at this level, but only once. So generally speaking, if you're dealing with a pass-through entity like that, it's just one level of tax. So it's not quite as punitive. It's not quite as negative. But if you're dealing with a C corporation, which we frequently are in the takeover world, because we're dealing with companies that are trying to scale and grow and for lots of other reasons, scaling and growing works nicely with the C corporation format. If we're dealing with a selling company that is a C corporation, double taxation. It's a huge downside to an asset sale. So buyers like asset sales. Why? Buyers like asset sales because they get to pick and choose assets and liabilities, and buyers like asset sales because they get a step up in basis. Sellers, particularly sellers of C corporations, tend to despise asset sales. Why? The headache and the cost associated with the wind down of the selling company, the liquidation and dissolution of the selling company, and then, if we're dealing with a C corporation, the pain of double taxation. Those are the two big negatives that attach to the asset sale format for stockholders. Another point on asset sales, which is tricky for buyers and sellers alike. So this falls in the category of a negative that both endure. There is the notion that buyers and sellers, let's put it differently. Our scenario is we have a selling corporation here, and we have a buyer here. Buyer, seller. And for whatever reason, they've decided to structure this as an asset sale. And they've sorted out the pros and cons to each, and they've decided that notwithstanding the back and forth and the good and the bad, et cetera, that they're doing this as an asset sale, and they're aligned on that. That means they've reached some agreement as to which assets and liabilities are making their way from the selling company to buyer. Inevitably, there will be contracts, agreements, probably commercial in nature, that seller is a party to that buyer will want to assume, that they will want to have assigned to them. These could be licenses for intellectual property that selling corporation has with some parties, okay? These could be commercial contracts pursuant to which they sell goods or services or products at a certain price over a certain term on a negotiated basis to some third party. So we're talking about all these third parties that exist out here that have entered into agreements and contracts over time with the selling company, and these contracts are important to the business, so important that buyer wants them, and buyer's probably paying for them, okay? So it's part of the acquisition, it's core to the deal. They need these contracts to make their way to migrate from the seller corporation to the buyer, and certainly included in purchase price. So it's not just an afterthought. This isn't just sort of administrative activity or technical activity. This is material. This is existential to the transaction. The question is, what does it mean to assign an agreement from seller to buyer? What does it mean for buyer to assume that agreement? Is it easily done? The answer, generally speaking, is no. These clauses take a variety of forms. If you happen to be dealing with a contract that's silent on assignability, the general rule is that either party can freely assign it. So, if we're looking at this particular contract and we review it and we find, oh, there's no assignment clause whatsoever. There's nothing in this contract that speaks to assignment. That means seller can freely assign it to buyer. Good. That doesn't happen very much. You generally are only going to see that with contracts that are sort of your third or fourth tier agreements. Very basic, very rudimentary, not highly material to either party, because highly material contracts are going to draw the attention of both parties. and they will likely include what we sometimes call an anti-assignment clause. Okay? And for our purposes, let's say these 3 agreements include an anti-assignment clause. What's an anti-assignment clause? An anti-assignment clause will say something to the effect of, neither party to this agreement may assign this agreement without the consent of the other party. Seller cannot assign this agreement to buyer without the consent of this counterparty, this other person to the contract. That's a flat anti-assignment clause. In that case, in order for buyer to assume that contract, to have it assigned to it, the parties will need to work together collaboratively to get that third party to agree to the assignment. Now, sometimes it's very easy. Sometimes counterparties are thrilled. You know, they may be working with a company that's relatively small, that's now selling to a company that's relatively big. And they may say, great, this is a more creditworthy company. It's a company with maybe more sizzle, a bigger brand. This is an exciting opportunity for us. We're thrilled to consent to this assignment. No big deal. Other times they're much more concerned. I mean, what if this counterparty thinks that this buyer is a potential competitor, or arguably a competitor? Some friction. We've got to negotiate our way through that. And it's a component that always appears in these transactions with at least some of these contracts. And it's something that needs to be managed and tended to. And it adds time to the deals, it adds friction to the deals, and it adds risk to the deals. Because what happens if you can't get over a material contract the buyer cares about? Well, maybe the deal doesn't get done if it's that material. Or maybe the deal gets done and the purchase price gets reduced. Or maybe the parties sort through this and come up with some other mechanic, but the point is, it introduces additional layers of interaction, static, noise, friction, difficulties in getting the transaction done. How else do anti-assignment clauses appear? Well, I just expressed the 2 poles. The lack of a clause, which allows free assignability, or the total prohibition, which says no assignability without consent. There's a middle ground anti-assignment clause, which says neither party to this agreement may assign this agreement to another party without the consent of the other party to the agreement, unless, or provided, however, or notwithstanding the foregoing, that's kind of magic legal language, something to that effect, unless it's in the context of a sale of all or substantially all of the assets of seller. In that case, free assignability is permitted. Whew. Buyer and seller breathe a sigh of relief. That's as good as the absence of an assignment clause. That means they don't need to get the consent of the third party. Seller can freely transfer it over. Why would a counterparty ever agree to that? Well, you know, a counterparty may sell their business too. So, you know, what's good for the goose is good for the gander. And there's a sense that with some agreements, yes, we don't want you just assigning these contracts in the ordinary course of business to some other third party in a way that we may not necessarily be comfortable with the configuration. But if you're actually selling your business, you're selling your company, we realize how heavy a transaction that is and how much is involved. And if that's what's taking place, we're comfortable just giving this sort of preemptive consent to that assignment. And it works both ways. But here's part of the point. When you're engaged in an asset sale, this activity is of critical importance for buyer and seller alike. Buyer has certain contracts that they want, and they need to make sure that they can get them. If it's just 2 contracts, Easy enough. Let's look at those 2 contracts, knock it out. What if it's 1,000 contracts? What if it's 10,000 contracts? What if it's 100,000 contracts? Who's doing that work? AI now? Sometimes. But that's a huge undertaking, and AI might be able to help you see during that sort of diligence process how these different assignment clauses sort out, but they're not going to take care of getting these consents. It's a heavy lift. And if buyer doesn't get everything they need, they have a decision to make. Do we still do the deal? Maybe we don't. Do we do the deal but reduce the purchase price? Well, that's you've opened up negotiations all over again. Or do we just paper over it, close over it, and say, you know what, we're going to take our chances. And sometimes buyers will do that. They probably aren't going to do it with the more strategic, absolutely core agreements, but there's a level of agreement beneath which they may say, you know what, just in this stream of business, we're going to assume that probably most of these counterparties are going to be okay with this, regardless of what this clause provides, if we continue to pay them, which is true. Or if for whatever reason there's one who falls off the boat, doesn't want to continue with the deal, we can backfill. It's not a big deal. So maybe it's an important contract, but it's not a highly material contract. But again, they have to go through that analysis. Seller, similarly, they're always concerned because they have a deal they want to get done, but this dependency on third parties can really inhibit their ability to close a transaction seamlessly and quickly and effortlessly. The other piece of it is look, whatever's left behind, they've got to deal with. So maybe in their mind, they were going to push all of these contracts over to buyer, but what if this contract here is not assignable, or the consent isn't received, or however it works, and buyer's willing to go ahead, the deal closes, renegotiated or not, well, now seller has to do something with this. They have to help shed it to sort of make sure that it moves to buyer informally, just through the ordinary course of business. They have to pay it off. Regardless, they have to pay attention to it. And they have to figure out a way to tie it out, because they're still on this active contract, before they're able to wrap up all this administrative activity here and then liquidate, dissolve, and wind up the company, crack open the eggshell, and distribute the proceeds out to the sellers, selling stockholders, more specifically. So we have pick and choose assets and liabilities, great for the buyer. Step up in basis, great for the buyer. Post-closing cleanup, bad for the seller. Double taxation, if this is a C corporation, bad for the seller. Assignment clauses loom very large in the asset sale context, and it's a burden on seller and buyer alike. One final point, which would be on the order of an advantage to both sides. So if this assignment clause wrestling match is a burden that both share, there's a benefit that both share. And that benefit is this. In an asset sale, under Section 271 and otherwise, selling stockholders have no appraisal rights or dissenters' rights. We will see those in the context of mergers, and we'll talk about those in the context of mergers. But in an asset sale, the selling stockholders do not have appraisal rights. And the reason for that is that, put very briefly, is that a merger is perceived as being more tied to the disposition of the actual stock, the holding of the seller. And that's their property. And you're extracting that from them in a merger transaction, if appraisal rights are going to be activated against their will. And as a consequence, they should be given some recourse, and the recourse is appraisal rights. As we've discussed, asset sales don't operate, or they're not perceived to operate or characterized to operate in the same way. Asset sales, instead of being seen so much as a top-down transaction, it's more of a highly elaborated bottom-up transaction. Corporations are engaged in They transact in their assets and liabilities all day long. It's just, this is a supercharged version of that. And by the way, the selling stockholders aren't even really actively involved, at least as it relates to their specific security, except to vote on it. But they're not selling their security to the buyer, they're still holding it. They're still owners of the selling company when the dust settles. So they don't have appraisal rights. It's a hurdle, it's an obstacle, it's another step that shows up in merger transactions, but does not show up in asset sales. And that's a benefit to buyer and seller alike. So, asset sales in a nutshell.